Welcome friends to the second webinar from the chain webinar on internal audits. Today we are having with us the eminent speakers CS Surath Mukherjee and CS Smriti Parikh on the topic of identifying frauds during internal audit and internal audit planning and sampling techniques. Now before we start, we request everybody to rise for the motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Thank you, Dipen. We have kept basically three chain webinars on the topic of internal audit. Today is our second webinar. Now on 16th, we are having third webinar of the series. Before wasting any time, I just request now CS Dedia to introduce the first speaker of the session.
Thank you, sir. Good evening, members. I'll introduce Smriti Parikh. First, she's a Vice President of and Compliance Control and Internal Control of Total Energies Marketing India Private Limited. She has been working there since November 2019 and was with Bombay Dyeing before that. She heads the Compliance and Internal Controls function. This includes all the governance activities for the company, right from risk management, compliance, IFC, investigations, to SOPs, along with controls testing and internal audits. She is instrumental in instituting a governance culture at the company and setting the tone of the top, since she is also part of the managing committee at Total Energies. Before that, she was working with Tata Power for around 5 years, and she was instrumental in setting up the internal audit department in Tata Power Group. She's a CA with 2 decades of experience. She has spent a lot of time in internal audit department and controls designing and testing. She has experience with 2 of the big 4 consulting firms like Deloitte and KPMG, California, USA. She was involved in engagements right from proposal to final engagement delivery across various sectors. She has certifications and degrees in BSI as an auditor for ISO standards for risk and business continuity. She is also CPA from California, USA. She enjoys good food, spiritual books, and classical dancing and watching movies. She has also won many accolades and recognition from IIA and Tata Power. As a token of appreciation, we would like to present an memento.
Thank you.
Yeah, please accept that. And on behalf of BCSC, we would contribute to CAPF fund on your behalf. Thank you.
Thank you.
Now I request Bijal to introduce the CS Surath Mukherjee, sir.
Thank you. Prior to joining ACC, he has been with Damia Bharat Group for around 13 years.
and he headed the internal audit of the group. He has been instrumental in setting the risk management functions as well as scaling up to match the expansion of the group, before which he had spent a decade with Sony India and also 5 years with Philips India. Over the past years, he has been led the leadership position in various MNCs and Indian organizations and have been able to contribute sustainable results for them in the field of accounting, finance, as well as risk assurance and controllership roles. With this brief introduction, I would like to present Momento to Mukherjee, sir, please.
Thank you.
Thank you, sir.
Thank you.
We request you to start the session. Thank you.
Okay. This. Yeah. So good evening, everyone.
Good evening.
Am I audible?
Yes, sir. Yes.
And the screen is also visible, right?
Yes, sir.
Yeah.
Yes,
So
sir.
thank you, Borivali Study Circle for giving me this opportunity for sharing my little knowledge and experience which I have developed over the past 3 decades. I have been in this profession. Sorry, I think I got dropped out in between. I'll start again.
Yes, yes. No issue.
This is the problem of going online.
Yeah. It's from next month onwards, we are having majority physical seminar.
Yeah, that's better. Much better. Rather than talking into this box. It's
Yeah.
been quite long time. Yeah. So, so let me start again. So my objectives are threefold. One is to raise awareness about internal audit's responsibilities relating to fraud detection and prevention, though that is not the primary reason why an internal auditor or an internal audit department exists. But in today's scenario, this is one of the key result area for the auditor. Second is to help auditors recognize the fact that fraud is all around us. It does happen, and also to help them to detect those fraud red flags, and also try to highlight some fraud audit techniques. So let me define internal audit, and there are hundreds of definitions in the market, but let me tell you what I like the most, which says internal auditors support management's effort to establish a culture that embraces ethics, honesty, and integrity. All of these are enemies of fraud. They assist management with the evaluation of internal control used to detect or mitigate fraud, evaluate the organization's assessment of fraud risk, and they are also involved in fraud investigation. So if there is an internal team like the one I lead or I have led in my past, or like the one Smriti also leads, we are also expected to be part of the fraud investigations. Now, on the left-hand side, I have put a small data point, which has come out of the latest ACFE study, which has been released in 2022, which says that internal audit is the second most important activity through which fraud is detected, while the top or most remains a tip-off or a whistleblowing or a ethical view complaint on a compliance hotline. That remains to be the topmost condition through which frauds are identified or frauds are brought to the light. But then internal audit at 16% is the next most potent. So it is very important for us to understand that if an internal audit is designed well and it is done in a position to protect the organization in a big way. Now coming to the role which internal audit plays in fraud prevention and detection, we have Institute of Internal Auditor Standards, which talks that internal auditors must consider the probability of significant errors, fraud, non-compliance, and other exposures when developing the engagement objectives, which means when you are planning for a work, when you are planning for a assignment, or you are planning for an assignment as an internal team, you should take into account how the organization can lose through significant errors, maybe intentional or unintentional, or fraud or non-compliance. In addition to several practice advisories the IIA has issued regarding frauds, the standards also require the Chief Audit Executive to include the significant risk exposure and control issues, including fraud risk, in the periodical report to the senior management and the board, which means that when we are presenting our report to the audit committee and to the other governance committees down the line, we should be not shying away from saying where a fraud risk exists, whether it has got materialized or not. That risk has to be identified and that needs to be called out. That's very, very important, because fraud is something which people don't like to talk about and people don't like to discuss too much, but it is our responsibility to bring it on the table. The internal audit activity must evaluate the potential for the occurrence of fraud and how the organization manages fraud risk. That is another key important area on which the auditor should have his eyes and he should comment. And last but not the least, they are talking about competence of the auditor to take up such assignments. The auditor must have sufficient knowledge to evaluate the risk of fraud and the manner in which it is managed by the organization. But as they say, we are not primarily responsible, and we'll see in the slides going forward that internal audit is not primarily responsible, but then we are the last net. If anything goes through us, that will go into the ecosystem and would get delivered as a fraud for sure. Now, the definition of fraud, just give me 1 minute. Yeah, definition of fraud as per Companies Act. Fraud in relation to affairs of a company or a body corporate includes, please note the highlighted words, any act, omission, concealment of any fact or abuse of position committed by any person or any other person with the connivance in any manner with intent to deceive, to gain undue advantage from, or to injure the interest of the company or its shareholder or its creditors or any other person, whether or not there is any wrongful gain or any wrongful loss. So if a fraud happens and the fraud doesn't result into any loss, that's not a good enough cause to sideline the same. So if anything, any act happens which is having a bad intent of harming the stakeholders of the organization, that needs to be put on the table. And then section 447 also talks about the punishment regarding the fraud, and it talks about some minimum parameters, and it could be the maximum parameters have can be anything. It can be an fine of at least 10 lakhs of rupees or 6 months imprisonment, and on the higher side, depending on the seriousness of the case, it can go to any extent. But these sections which have been newly inducted in the Companies Act 2013 has really set the ball rolling. And as we can see these days, government is taking the risk of fraud, and the people who are responsible for either perpetrating it, or people who are responsible for stopping it from happening, or people who are responsible for taking it to light if those stakeholders have not done their work properly, then the government and the various regulatory authorities are coming down heavily on the professionals. So as professionals, we need to be really, really conscious and cautious about our role in this area. Now, what can go wrong? What are the detrimental effects or the bad effects of fraud? Now, there are many, but to list down a few, one is loss of investor confidence, customer confidence, lender, regulator, all stakeholder confidence. So if a fraud happens, you will see people shying away from that organization. Though the business model is good, but the fraud actually makes people feel shaky. And as stakeholders shy away, the next inevitable condition is that there will be loss of sales market share and the standing of the organization in terms of the market share and the influence that has on the people. Loss of access to financing. Obviously, your credit rating will fall and then your financing will be at a much higher cost, which obviously is a straight effect on your financials. Withdrawal or refusal of licenses. Management, good management people could leave you. People who may not be associated with the company with the fraud, this thing, and also bankruptcy and liquidation. Because if all of these preconditions, they fall on each other, it may lead to bankruptcy or stoppage of business or even liquidation, because there could be many other cases also which may come up for damages, for penalties and stuff like that. And in many cases, the company actually winds up. Now, in terms of fraud risk, we have two types of fraud risk. One is employee fraud and one is a management fraud. Now, employee fraud is committed for the benefit of the individual or the group to the detriment of the company. In many cases, we have seen that there are many, but typically they don't bring companies down. That's the way I see it. But the second one, the management fraud, is a much more devilish in nature, because that is where the people who are the custodians of the organization's process, controls, management, and day-to-day working, they come into play. They create a coterie, and then they start doing things which are for the so-called short-term benefit of the organization or for the group of people. So management fraud is also a kind of employee fraud, but it is at a much larger level. It is very difficult to detect and sometimes very difficult to also raise a voice against. And that is where the most of the companies, they come down. So management fraud is the most dangerous form of fraud. So we as auditors, whether internal or external, has a major responsibility in this regard to sound of the governance platforms that something what is being happening on a consistent basis is not right. Let's not confuse errors with frauds. There could be errors, there could be entries which are missed out, capitalizations which are missed out, sales transactions which are not recorded in a proper manner, but we have to be able to be mature enough to differentiate between errors and fraud. Fraud is done with an objective to fool people around the organizations, people who are depending on those books of records. What are the examples of management fraud? These are acts where the principal benefit of the act are derived by the company. Examples include financial statement fraud, bribery, influence peddling, price fixing, contract bidding fraud, all of this through which you are making sure that the company is not fair in its dealing, not fair in its accounting, not fair in its disclosure, not competent enough to garner business, so they have to bribe. Of late, we are hearing a lot of companies where people are being arrested for alleged payment of bribes or favors. So this is something which we had always thought about, that it happens on the background, but it is now coming up very severely, and company officials are getting booked for it. So we have to be really very careful how that is flowing. Influence peddling, price fixation or cartelization, as we call it. I come from an industry which is plagued with this kind of complaints, and litigations of price fixing, contract bidding fraud, where you are trying to manipulate the pricing or the contract and trying to gain. So in all these cases, basically the idea is to look good. The idea that the company, the business model, the people, the management should look good, and people will then come and invest. The ratings will improve, financing costs will go down, and the company will grow. But if this misses a step or two, it can lead to a free fall, and thereby all the stakeholders lose money, whether it be the banks, the investors, the shareholders, the employees, the customers, the vendor, everybody loses. Nobody is a winner in a IBC process. Characteristics of a typical management fraudster. There are superficial charm. There are this kind of a snob behavior of self-worth. There is a tendency to peddle lies about the future plans, about the future growth, about a rosy future. There could be lack of remorse or guilt, because if you're doing all the three above and you're still not introspecting and still not trying to find out that which way the organization is going, then you are bound to be in a very, very difficult spot. Shallow emotion, lack of empathy, failure to accept responsibility for own actions, because in many cases, when larger frauds are being done, small green shoots are caught in the public domain or in the accounting audits and other stuff. But whether they understand what could really, really go wrong in case this snowballs into the larger pandemic or the larger epidemic, what will happen? How many people will lose job? But those people are remorseless. Employee fraud examples: embezzlement or theft of company property, travel and entertainment fraud, vendor kickbacks, diversion of corporate opportunities, like an order which is coming to the company is diverted to a shell company to be rerouted back to the company, or in certain cases, you are at the cost of the company diverting the order to a competitor. Unauthorized use of company property: you are sitting inside the office and doing your own work, or using the company vehicle for your own work, or you are transporting goods in the company's vehicle. It could be a different nature. What are the characteristics of an employee fraudster? Obviously, his lifestyle doesn't fit his salary. He has got much more in money and assets as compared to what he is earning or he's supposed to hold. He may have problems at home, problems dealing with pressure. That pressure could be to complete a sale, or to complete a target, or to show a reduced inventory, or to show a better debtors condition. Those leads to these activities which could be fraudulent in nature. Then there is heavy debt. So the person has a lavish lifestyle and he has borrowed personal loans and loans at high cost, which he needs to service or needs to repay. Real or imagined grievances, wherein sometimes people feel that I am not rewarded enough, I am not compensated enough, I am working more, but the company doesn't take care of me. So the idea is to then fleece the company and gain the financial advantage. Takes little or no vacation. Sometimes this is seen as a great employee quality, but when you look deep within, you find that the person is afraid of leaving his seat and his position, because every single day he's manipulating something or the other and making lots and lots of money. So he knows that if he leaves his place, then his evil motives can be exposed. So he doesn't want to leave his place. He works odd hours. He is low on morale, which is again, linked to the real or imagined grievances. So he feels that he's not being looked after by the organization. There could be drug or gambling problems, which will lead to, again, the spiraling debts, and also somebody who has a history of illegal acts. Background verification, though it is there, as a process in most of the companies. I have seen it myself that it is done in a very, very casual and a very, very shoddy manner. Maybe leaving the topmost layer of the people who are recruited at the other level of people, where people are actually doing tasks for you, actually in charge of assets, actually in charge of your machinery. While hiring them, the reference check and the background checks many a times are very, very shallow. Sometimes even negative report comes or inconclusive report comes, and we just take it on our strides and we allow the person to work. So one such black sheep could actually lead to a lot of problems inside the organization, and also it could lead to other people also getting motivated by such act, and the culture of the company can actually go for a toss. Some of the common embezzlement schemes, utilization, these going forward we'll discuss in further detail, but utilization of fictitious vendor, submission of unauthorized travel and expense reports, wherein you can fabricate your reports, you can submit duplicate reports, you can submit reports which have those expenses have never happened. You could modify bills. In these days, it is very easy to download and modify files, create your own files, and hence submit such expenses which has never happened or has happened in a much lower amount. Submission of request with insufficient documentation, creating and appointing onboarding fictitious customers, manipulation of different kinds of reconciliation. It could be bank reconciliation, cash reconciliation, it could be inventory reconciliation, use of suspense accounts or other prepaid accounts. Some of these accounts are sometimes below the radar, and the fraudster uses those accounts to manipulate the overall ecosystem. Now coming to the famous fraud triangle. Why good people do wrong things? So in the beginning, when we are talking about in this slide about the culture which is created by onboarding people who are not believing in your culture, what you do is that you actually start a domino effect wherein good people are also convinced to do acts which go against them or against the company. So the famous fraud triangle talks about three aspects. One is there is a pressure to deliver. There is a pressure to do an act or to achieve a top line or to achieve a bottom line or to achieve a number. That could be a real pressure or a perceived pressure. Maybe if you don't do the numbers, nothing will happen.
હું 270 સર્ચ કરવા ગઈ એમાંથી મને આ મળ્યું કે આ તો બે વાર લેવાઈ ગયું છે આવી રીતનું. હવે અહીંયા શું કર્યું, મે મહિનામાં ફરીથી બિલ લીધું. એક તો મે માં એન્ટ્રી કોપી કરવાની નહોતી, તો મેં મેમાં એન્ટ્રી કોપી કરી. એન્ટ્રી કોપી કરી એટલે શું થયું, આ જે બિલ છે આનો પાર્ટ બની ગયું. પછી દિમાગ શું લગાવ્યો, આ 143 મહિનો ટોટલ છે ને નાખી દો અહીં.
Bijal, hello.
પછી સેકન્ડ ફાઈલમાં રિવર્સલ છે યલો.
Thank you. So there is pressure, real or perceived, and based on the pressure, they have created their rationalization of their actions, whatever they are doing. They feel that whatever they are doing, whatever wrong thing they are doing, that is justified because there is a lot of pressure for them. If they don't achieve, then they will be thrown out of the organizations or they will be punished. And to do that, they find out opportunities. They find out that if there are control weaknesses, if there are threats that they would be caught, how much is the likelihood that their act will be deceived or their act will be detected? So these three conditions, if they come together, that creates an absolute venomous opportunity of a fraud triangle or of a fraud, wherein you have opportunities, you have pressure, and you have a rationalization. So when we generally interview fraudsters, we see that when they have acted, they are trying to fit into any of these quadrants. Now coming to motives for fraud. What can be the motives for fraud? One could be that the financial problem will be solved. Second could be the lifestyle could be enhanced. Third could be if there is tremendous pressure and the person is working long hours through Saturday and Sunday and feel that they're not recognized, then there is a mentality of taking revenge against the company. Conceal illegal acts. Sometimes there is an ego, wherein the ego is to beat the system. Then there is personal ambition, and also to meet the incentive which are there in case you meet the top line or the bottom line objectives for which you are under pressure. These are some of the personal goals. And in corporate, you have the capacity and the authority to manipulate the system. So you reach or exceed the quotas and the goals, increase your popularity and reputation, maintain the ability to borrow, personal ambition of the C-suite employees, the CEO, CFO, CEO, MD, manipulate stock and stock price and stock value by way of showing better numbers, better results, better future forecasts, and also meet regulatory requirements. Sometimes by hiding something or by reporting something wrong, you are apparently meeting the regulatory requirements, wherein you are actually sitting outside the box. Now, in terms of the overall structure, we have what we call the 3 line of defense, wherein the first line of defense is the code of conduct, business ethics policies, and the control procedures in which people are actually working, based on which people are actually taking care of their day-to-day objectives and day-to-day business acts. The second line is the internal control and the management control structure, wherein the people who are supposed to be the maker and the checker, they are working, they are trying to find out if there is a deviation, and then they are correcting it, rectifying it, sending the data and the documents back to the front line. And the third line, you can say, is the goalkeeper, is the internal audit activities. This could be an internal team or it could be an external team. And that is kind of a goalkeeper, and its presence is very much important. It's very much important as a strong deterrent to fraud prevention, detection, and control. But if it passes through this, it is highly likely that it will cause the major damage to the organization. Maybe not in one go, but in bits and pieces, and slowly but surely, someday or the other, the organization will start showing the fatigue of such fraudster activities. The first line of defense is the ethics, policies, and the procedures based on the assessment of the possible risk facing the company, and understandable written employee code of conduct and business ethics document should be in place, and it should be well circulated, and the people should be well trained about it. People should be aware what are the consequences in case they are doing some illegal activity. They should be clearly told what is right and what is wrong. And management has a zero tolerance policy on intentional misstatement or intentional acts. And management sees them more strongly as compared to errors. So errors can be condoned, errors can be pardoned, errors can be understood. But if intentional harm or intentional bypass of the policies and the procedure is done, then the organization will not take it lying down, and a very strong action will be taken against such people. That should be very well communicated, and every employee should actually sign the dotted lines once while joining the organization, and then on an annual basis. And there has to be a training and development which has to happen for all the people in this regard. Ethics, policies, and procedure. It includes the deterrence elements, includes the detection elements, is value-based and not rule-based, has a positive tone, promoting a better workplace, and requires a fair employer-employee balance. It cannot discriminate between who does the error. So it's not that if a managing director does an error, he is condoned, and if a shop floor employee does an error, he is thrown out of the organization. That is now how you promote a fair culture. So you have to create a culture wherein the rule in this aspect is same for everybody. And when they sign a dotted line, they are serious about it. It has to be value-based and not rule-based. There cannot be any structure as to who does the same mistakes and how they are actioned against. The second line of defense, effective internal control and management organization structures provide both preventive and detective elements. This is very important when we are structuring the organization, the operating model, where you will have an SOP, which will tell us how to do the job. And then we have both preventive and detective controls ingrained into the same. So somewhere you will be stopped from doing an activity which is not legal or not as per the company values and standards. And somewhere, if you cross that line, an error will be detected and a flag will be raised and an MIS report will be triggered and it will land into your supervisor's desk, right? But there is not significant deterrence out here because this platform will highlight your problem and send it back to the ecosystem for correction. So they are not the ones who would actually think in the lines of fraud controls because they are the operating people. Hundreds and thousands of transactions are flowing into them. In case they find anything which they feel is bad or they feel is something which is with intent or wrong intent, then they will hand it over to the internal audit department for a deeper investigation. So that is how the process has to follow. But they are not the ones who will do investigation or think that the people working in the system are having lower integrity or they can lose the value of trust, which is very important in a business and in an operating ecosystem. And now coming to internal audit, the third line of defense, they would do operation and internal control reviews. They will do analytical procedures to isolate the differences or the anomalies, detailed reviews of high control and inherent risk accounts and transactions. And internal audit does not necessarily represent a deterrence element because of predictability issue. What we are trying to say out here is that there's a difference between a forensic audit or an investigative audit and an internal audit, because when we do an internal audit, we come from a position of trust. We trust the people when we are given a document or an approval or an email is shown to us, or when data is given to us. In many of the cases, we are trusting the version of the employee. And many times in the normal audit, there is a schedule, there is a structure, there is a scope, and there is a plan which is pre-announced. So in many cases, the fraudsters in certain cases becomes aware that an audit is happening. So they try to lie low. So in this, we use surprise audits and we use unannounced audits in certain areas to make sure that we are able to catch the operation as they are happening without having an announced thing. So areas like cash verification, inventory verification, surprise safety checks, surprise inventory valuation checks, surprise asset count, surprise stores and spares check, surprise customer visits, customer site visits are done just to see what is being shown in the books and what's happening on the ground are matching with each other or not. So based on risk assessment of fraud and illegal acts, internal audit evaluates the first and the second line of defense mitigators, and the mitigators are consistently and elaborately tested. So if you are saying that if there is a three-way match, it will work beyond fail, then as an auditor, we have to go ahead and make sure that under no circumstances or under no business scenario, this three-way match can be bypassed. And if at all that can be bypassed, there is a clear system of having a exception flag off, which is then signed up by a higher authority. So all such preventive and detective controls has to be checked in detail. So if the mitigators are working effectively, analytical procedure and other tests are needed to isolate and identify any anomalies that may be present. If there are no mitigators or ineffective mitigators, then internal audit must design fraud and illegal act substantive audit procedures. In effect, they must search for fraud and illegal acts. So if we are not having satisfaction around the effective operation of the preventive and detective controls, then we cannot just comment there and take a step back. We have to devise our own mechanism and our own test and control to give an assurance to the management that things are either right or things are not right, and what are the mitigative and additional measures that needs to be done. We may sometimes do things in a sample, but sometimes some areas may require a thorough check to make sure nothing is going below the radar. Now, what is fraud detection? Fraud detection is the analytical procedure that enables discovery of anomalies and the procedure that provide for communication of suspected fraud or illegal acts. Now, what is very important to note of what the ACFE survey has said is that detection is an essential step in fraud investigation, because the speed with which fraud is detected, as well as the way it is detected, can have a substantial impact on the magnitude of the fraud. So the earlier the fraud is detected, the lower is the cost associated with the fraud, or lower is the damage. It is also an important component of fraud prevention, because fraud examiners can take steps to improve how they detect fraud within their organization. As a result, this might increase staff's perception that fraud will be detected and possibly deter future misconduct. Our data explores how fraud is initially detected, when it is detected, and who reports it. That is where they said that whistleblowing and internal audit almost cater to 60% of the fraud detection or fraud highlighting. But it is very important that through our internal audit procedure, we have this perception live in the minds of the people that if I do something, there is a high probability that I may get caught. So any such act, any such device, or any such control design would make sure that people think twice. So it's just like having a policeman standing on the corner of the traffic signal, or a CCTV camera on the road which detects a traffic violation. All the places where these kind of things are there, people think, and 99% of the people will abide by the rules and they will not break the rules, wherein 1% is always unpredictable and always of that nature wherein they are challenging the system every now and then. Now, in fraud prevention, we have the procedure, systems, and organizational structures that provide obstacle to those who attempt to commit fraud and illegal act. They include the internal control mechanism and the structure. So if you have a good, sturdy internal control mechanism, reporting mechanism, internal control questionnaire checklist, IFC checklist being filled, and there is a strong internal audit department who does an audit, maybe internal, maybe external, then what kind of management controls are there? How the MISs are reviewed, how exceptions are dealt with, how is the management organizational structure laid down? Is it a centralized one? Is it a decentralized one? How is segregation of duty done, both physically as well as in IT systems? I'll take this in detail going forward, but segregation of duty is very, very important. IT controls these days, because every organizations are using not one, two, but many IT systems, from ERP systems to apps to separate standalone systems. The IT controls are very, very important. Otherwise, that could lead to catastrophic control disaster. And if we see out here, if we see on the right hand side, again, I have pulled out a data from the ACAP survey, which says that implementation rates for 17 of the 18 analyzed anti-fraud controls have increased over the past decade, which means that every company is taking fraud very seriously. So if you see implementation of the employee hotline, which is one of the key drivers for identification of fraud, has increased by 16%. Fraud training to employees to make them aware how or where a fraud can happen and what eventually happens when a fraud happens, how the company suffers and how they suffer in turn, that has gone up by 14%. Anti-fraud policy, having a structured anti-fraud policy, has gone up by 13%. Fraud training, discussing about how a fraud can happen in a so-called structured setup or a structured organization, has gone up by 12%. And fraud risk assessment formally being done, where scenarios are created, tested, documented, and specific controls are designed around them. Such fraud risk assessments have also increased by 11%. So which proves that fraud is here to stay, and it has a serious bite on the company's profitability and company's going concern capability. So people, the management and the ethical lot have become more sensitive. Companies are increasingly placing more emphasis on deterrence and prevention rather than detection, because what is perceived is that by the time it is detected, it may be too late. It may be too little too late. A lot of value would have flown through. So the company is putting increasingly more emphasis on deterrence and prevention. How to create watertight systems, how to create maker-checker control, how to create flag of reports, moment a standard control or a standard process is bypassed. And there are cockpits created who would immediately capture the transaction and maybe put it on hold. So if you see in these days, if you do a credit card transaction of a certain value, the transaction is put on hold, we get a call. And once we approve on the call, then only the transaction is processed. You will see the bill processing happening, the slip coming out only when you say yes to the transaction. So they're holding the transaction. They don't mind if the transaction fails once or twice, right? So what is important out here is that having a clear code of business conduct on the principles, on the policies, on the procedure. How will that particular policy be communicated? What will be the consequences of such frauds and such fraudsters? How will they be dealt with? Whether the company will ask them to separate, whether they will be terminated, whether they will be handed over to the law enforcement agencies. These are very, very important. So if you see, again, the ACAP report talks about that high authority frauds are on a rise, which is a very, very dangerous trend. So people who are responsible for stopping fraud, people who are responsible for making sure all the other people are in control and they are following the processes, are they themselves becoming more gullible to fraud. So from 2012, in the last 10 years, from 56%, the top management fraud has gone to 62%, which means either it's a manager, executive, or a promoter level person who has done the fraud. The percentage of cases in corruption is also on the rise, from 33% to 50%. So people are ready to do business. People are ready to get business by hook or by crook. These recent cases which are now doing rounds are an example of that. Otherwise, you need not get into that. And fraudsters are collaborating more. What we can see that earlier, when you used to find a fraud, there would be one person, but now we are seeing that there are a group of people who are collaborating. So this may be a result because companies are putting tougher systems, they are putting maker-checker controls, they are doing segregation of duty. So now, unless and until you have a larger number of people who are motivated to do a fraud, the fraud would not take place. It will get highlighted. So you have to make sure you have a larger team of people who are collaborating with each other to fleece the company. So which is again another dangerous trend, which means that the maker-checker control may be compromised in many cases. Now, how fraud deterrence is achieved? It is achieved through the organizational attitude towards controls, organizational goals and objectives, the adequacy of the written fraud policy, authorization policies, control over high risk activities, transactions and assets, and how the communication channels are dealing with it. So if a fraud is unearthed, are we putting it under the carpet and feeling embarrassed ourselves, or we are going ahead and talking about it? We are going ahead and educating people around it. We are telling clearly that this individual has been terminated because he's a fraudster, and we have taken a strong action against him. He's going to face a jail term. So that consequence management is the most important thing. Fraud prevention recommendation: we need to screen potential perpetrators, reduce opportunities available through appropriate internal controls, create an environment where dishonest acts are reported and punished by developing a strong code of ethics, a strong anti-fraud policy, a strong conflict of interest policy, and a effective whistleblower methodology where independent people are in charge of doing investigations and coming up with very, very impartial findings, whosoever be the authority who is alleged against. Create an environment where employees believe that dishonest acts will be detected and punished. So we have to create that environment of assurance where people will think that if somebody does something wrong, then he or she will be taken to task. His caste, creed, sex, level in the organization will not become a deterrent for the organization to act against the individual. When you have an effective anti-fraud program, what happens is that there is a reduction of companies' risk of fraud. There is mitigation of fines and penalties. There is increased control over the business risks. There is increased control over costs. So you don't lose money by way of extra cost. Reduction of reputation risk, which is the most important. Once you lose your reputation, once you lose your credibility, once you lose your brand, then nothing works. No future development product works, right? And we have seen many such brands, needless to name them, who are still in the market, but they are struggling. They are not able to take off just because the consumers have lost faith on those companies or those promoters or those groups. Now, when computer-related fraud goes undetected, under what circumstances? When controls are overridden, when the symptoms which are thrown out of such exception transactions are not investigated, somebody is not looking at the logs, somebody is not looking at those controls, procedures to investigate symptoms are not understood, audit reports showing symptoms are not taken seriously, reconciliations aren't utilized to research or deep dive or drill down on the variances, and also there is no diligent follow-up. So many times we create systems, many times we create infrastructure, many times we create reports which throws up tons and tons of exceptions. Some of them may be false positives also. But at the end of the day, we have to make sure that there is a cockpit which manages those exceptions, a cockpit which looks at those exceptions and then set them aside. But if there is no cockpit, then those exceptions will come, they will be popping up and they will be sitting idle, telling you very clearly that things are not going right. So it is very important that when you create preventive and detective controls and put IT controls around it, you are also able to pick up those exceptions and dwell deep inside those exceptions to understand whether they are normal business calls or false positives, as we call, or there is a fraudster who is trying to break into your system or has already broken into your system and has taken the honey out of it. Through computer, there are opportunities around unauthorized transactions, data theft, changes in program for personal gain, direct file changes, fraudulent fraud transfer, sabotaging equipment or a system by loading viruses into it, So when we are depending on IT or when we are depending on computer to stop frauds from happening or to protect us, we also need to be very, very clear that manipulation of that IT system could lead us to severe consequences. So again, there has to be a security operations center which should be absolutely bang on the operating effectiveness of the server, as well as the ERP ecosystem, as well as the application ecosystem, so that any attempt to do anything unauthorized, be it a transaction, be it an access, be it a retrieval or downloading of data, or any unauthorized changes are not only identified, but they are stopped. You cannot allow the change to happen. You have to stop the transaction and go for an approval of the same from the appropriate authority before the transaction is allowed to move into the main system. How the computer can be used for fraud detection? We can search for duplicate payments because you are now working on an ERP mechanism. So you can search for duplicate payments. We can analyze reversals or voids and refund by employees using passwords or employee ID numbers. Search for duplicate address within files, payroll, vendor, account receivable, write-off. Analyze use of overriding transaction. Analyze file maintenance on employee accounts. List large payments to individuals. And I'll have a separate section in which I have in detail discussed about some of these control procedures. Now in recent, what the fraud scenarios we'll see is, these are few of the key areas through which fraud is done. One is implanting a fictitious vendor in your supply ecosystem. Rebate systems or rebate programs or credit notes which are given. This is as good as cash. So if any program is manipulated or any program is toyed around with or compromised with, you can actually end up paying large sums of money to undesirable people or vendors or customers. Collusion through duplicate invoices, and also concealment in financial statements. Concealment in financial statement means you are actually not highlighting or not properly disclosing expenses, income, provision, contingent liability. It could be anything which you are supposed to disclose, but you are not disclosing. You're supposed to take into your books, but you are not doing. So if you see here, it's a fictitious vendor fraud wherein you are having a company XYZ who has a weak control in the purchase order or in the vendor master maintenance and segregation of duty. So which the external world looks into as an opportunity. So they create a shell company or a phony company and also create their public records. They create their website, they create their past records data, and then they create invoices and push it in the XYZ company's domain. And such XYZ company's domain approves such invoices and funds is paid back to this phony company. And the cycle can be repeated a number of times. There could be duplicate invoices, there could be frauds in the receipt, there could be three-way match which could be compromised, there could be payments which could be made through journal entries and so on and so forth. Fictitious rebate programs in which you have the rebate checks being sent to the controller, and the controller, instead of accounting for it, routes it through cash and siphons of the money by way of a fictitious voucher. So this is another area in which if there is no maker checker or no segregation of duty, the flow of money could be compromised and it could be siphoned off. Collusion through duplicate invoices. Another, you can say, a pandemic in which the vendor submits genuine invoices first and gets it paid, and then after a certain period of time, with a little bit of an alteration, the vendor submits the invoices again, and there is a corrupt manager or a conduit sitting inside the organization who approves the second invoices also and makes the payment. So the payment could be split into multiple structures, or the payment could be distributed to multiple alternate payees, and it could be masked accordingly. And here you see that concealment in financial statement, in which you have personal or unauthorized expenses are recorded to suspense account. Now, suspense account is another account which could be misused to a great extent. Small amounts transferred to other accounts from that suspense account using journal entries, and then they are getting paid off. So any suspense account, any suspense credits, any unreconciled credit should be immediately written back to the books, else there is a fraudster which is waiting around the corner to compromise. Definition of financial statement fraud: it's the deliberate misrepresentation of the financial condition of the enterprise accomplished through an intentional misstatement or omission of amounts or disclosure in the financial statement to deceive financial statement users. So the objective here is that the investor, the reader of the financial statement, should be fooled. They should be the one who should be deceived in to invest more in the organization. So typically, the objective is to overstate assets or revenue or understate liabilities and expenses, thereby showing a much better picture of the company in compared to where they actually are. So the various schemes which are there are obviously recording fictitious revenue, creating timing distance difference between the transactions. So the revenue is booked in one period and the cost is booked in another period. So there will be fluctuation in profitability, gross margin, improper asset valuation, concealed liabilities and expenses, improper disclosure. Then you have related party frauds and conflict of interest. These are the two are the greatest things in which the all the governance authorities like SEBI and the ICAI and the government is working on related party frauds and conflict of interest. Now we come to some fraud checks. I have listed down few of the fraud checks which can be done in various sub processes. Like for example, in vendor maintenance, you have invalid vendor, a new vendor with lot of missing details. So by doing data analytics, by doing analysis of the data which we have in our ERP system, we can find out a vendor where the name is missing, or the primary vendor site itself is missing, or the vendor's primary address is missing, or vendor payment term is missing, or the vendor has been created or updated by an unauthorized user. All of these are red flags, because if a proper vendor is created, then none of these fields would be blank. None of these fields will be redundant. Then vendor site is missing. So if you are supplying goods and services, you see and check physically that if the vendor is running a proper site, both in terms of physical site as well as a website in which details are given about the business of the organization and their past customers. Vendor duplicate, again another cause of concern. Both vendors have the same name, both vendors have the same compressed name, names are similar. So by using fuzzy logic with different characteristics, you can find out if the names are similar in nature, whether they are coming from the same house or they are pushed into the system to create a fraud against the organization. Duplicate vendor, another big area. Both vendors have the same primary address. Both vendors have the same phone number, same bank account number, same tax ID, same default payment terms. So the idea is that somebody has created a duplicate vendor, or somebody has created a vendor through which they want to siphon off the money. Vendor change, master change and change back. What it means is that you are changing the vendor master or any master for that matter, and then transacting and then reverting back to the original state, which means that you are changing the parameters to make sure that the transaction goes through. A vendor's name was altered and then returned to the original name. A vendor's primary address was altered and then returned to its original address. A vendor's remittance to address was altered and returned. A vendor's bank account was altered and then returned, which means for a specific transaction, the transaction flow happened in a different manner, in a different way. So this could happen for everything, for vendor, for customer, for any master data. It's a very, very important thing to have a check on this audit trail as to how the masters have been changed and why they have been changed. Vendor bank account duplicate. The same bank account relates to two different vendors, which is highly unlikely. Or if it is so, then they are definitely related. Vendor bank account change and then change back. This is the same thing which I was saying earlier, that the vendor ID was altered and then returned to the original state. Account number was altered and then returned to the original state. Now this is very important. Why would a need arise? I have seen in my career that people played around with credit limits. So credit limit was made from 20 lakh to 30 lakh. One transaction was made to go through and then it was reverted back from 30 lakhs to 20 lakhs. Both are unapproved transactions. Later on, when we checked and we saw that there were higher outstanding, then when we checked that how the system allowed a higher billing as compared to the limit which is there in the system, we found out that somebody was playing this game of lifting the barrier and allowing the transaction to move through and then reverting back. PO to invalid vendor. Purchase order was issued to vendor who has missing detail or doesn't contain valid information. It was issued to vendor whose site was not verified. So which means that the corrupt ecosystem is in play and now we are placing order on such vendors who are not available. So such vendors who are not having the due credence should be blocked in the system and should be marked for deletion. And anybody who tries to open them and act on them should be immediately flagged and immediately questioned. In PO processing, you have vendor is missing from the purchase order, vendor order amount is 0. So you are creating a dummy PO. Later on, you can go for a PO amendment and you can change the value of the PO. The street address was altered and returned to the original state. Remittance flag was altered and returned to the original stage. PO to inactive vendor, again something which is another cause of concern. When you have inactive vendors, inactive customers, sometimes they are having balances also. So there is a tendency that those balances are paid off to somebody else. So whenever you have an inactive vendor or a redundant vendor, that customer master should be sanitized and blocked, and the unblocking should not happen at a lower level. The unblocking should happen at a higher level. PO to inactive vendor, PO, the amount of purchase order is outside the norm of the buyer. So somebody buys never has bought more than 5 lakh and you suddenly have a purchase order of 5 crore on that particular buyer is a cause of concern. That whether it's an error by design or a real error. PO approval, segregation of duty. The same person entered and approved the PO. So segregation of duty in IT is very, very important. If the same person is doing multiple activities, that should be stopped and should be given to two different set of people. In invoice vouchering, voucher to invalid vendor, voucher was issued to vendor who is having missing details or contains invalid information. Voucher was issued to vendor site which is missing details. Voucher to inactive vendor. Segregation of duty issues here. The same person entered the voucher and maintained the associated vendor. Same person entered the voucher and maintained the site record of the vendor. Vendor payment irregularity. Payment was issued to an employee for an amount that is 2 times the standard deviation higher than the average payment made in the past. So whenever you are giving an order, making a payment which is way high than his average payment, one should stop and check for the validity of the transaction, whether the goods and services have really come inside the organization. Payment type difference. Payment was issued to a vendor in the form of a check, though the vendor prefers another form of payment. So the bank transfer is the mode through which the payment generally goes, but suddenly a check is cut for the vendor's payment. This should give us a red flag. The payment mode was changed for a particular site. So all across India, the payment is being made through bank transfer, but in one particular site, the payment is made through a check. Payment line duplicate. Two payment exists for the same voucher. Two payment line exists for the same voucher. Multiple payments for the same voucher. In receiving, receipt quality greater than purchase order line quality, but within the tolerance limit overall set. So if you are accepting 10% extra material, where is that material going to go? Receipt distribution exceed PO line distribution. Receipt distribution quality greater than purchase order line quantity, but within tolerance. Receipt calendar segregation of duty. In receiving also, the person who maintains the calendar is the same as the person who is entering the receipt. The person who maintains the chart of account is the same who is maintaining the receipt. In inventory count, again segregation of duty. Preparation of a cycle count should not be the one who is doing the cycle count. Person responsible for inventory should not be doing inventory counting. Requisition ID is missing. Inventory quantity is missing. Two requisitions for the same item ID and quantity within 1 week of each other. In case the item is not something which is a item which is ordered as a reorder quantity. Requisition exceeds reorder quantity. Requisition exceeds the periodic usage quantity. In case of assets, we check for the duplicate assets, assets created, but the asset never physically arrived. Payments are going. Here also segregation of duties will come into play. Person who initiates a disposal should not be the person who approves the transaction. Person who initiates a disposal should not be the person who records the transaction. So if you are in charge of doing the similar transaction, wherein you are the person who is going to dispose of the asset, and you are the same person who is going to also record the transaction, there is a chance that one can manipulate. Similarly, in journal entry process also, the entire segregation of duty aspect needs to be checked. That if the user has both the journal entry and delete credit memo permissions, user has both journal entry and cash receipt permissions. So one can steal cash of the asset and then pass entries to nullify the same. So finally, to sum up, internal audit is responsible for ensuring the existence of control with system designed to prevent or deter the forms of fraud, identifying areas of risk where theft or manipulation may be likely to occur, ensuring adequacy and effectiveness of controls in financial accounting and other areas subject to theft, fraud, and embezzlement, exercising the care and skill of a reasonably prudent and competent professional, sharing the findings in an impartial and independent manner with the governance body and the management, disclose the findings to relevant authorities as per statute, and last but not the least, in a lighter mode, pray to Almighty on a daily basis that everything goes right and no severe, or you can say, surprise jumps up. So that's all from my side. Thank you so much for the opportunity to share my experience to you all. I'm open to any questions.
Yeah, depends. Will you take up?
Yes, sir. There is one question. It is regarding internal audit. It is a big phrase, especially when an auditor is appointed by the management of the society. Unless and until a statutory, the internal auditor is appointed by external authorities like SEBI, because when a management itself appoints an auditor, he defines the scope of the auditor, even the remuneration for the internal auditor. What does IC or other regulators do, especially in the lights of PNB, Nirav scam, Mehta Choksi scam, DHFL, India Bulls, Thomas Cook, etc.? Your views on this and how to do it? If not, I see it.
Yeah, so I think this I have covered this in the presentation also, that yes, auditor is a part of the ecosystem, is part of the internal ecosystem. Either they can be internal employees, or they could be somebody who is appointed by the management or the board or the audit committee. So audit committee here is obviously made up of independent directors, and they are the people who appoint the auditors. So the auditors have to be fearless. And today is the time when you cannot look into your job or your remuneration which comes out of your job, but you have to be independent and very, very upfront in coming with your views. And in case you feel that that is not what you are able to do, then you have to quit the assignment and put your resignation, instead of giving a report which is not the true self of what has been unearthed by our investigation. So we have to bite the bullet and make sure that whatever we are reporting back, whatever mandate we have been given, we have to do full justice to the same. Irrespective of how we are appointed, our report at the end of the day are signed by us, and they should carry the proper, factual, independent, impartial observations. If we compromise on our quality, if we compromise on our ethics, if we compromise on what we have seen, then as a profession, we will cease to exist. We are in that particular crossroads, is what I believe.
Right, sir. Right, rightly said, sir. Friends, everybody must be agree that Surath sir has enlightened that how internal audit can be used to detect and to deter the fraud in the corporates. Now I request Deepen to propose the hearty vote of thanks to Surath sir.
Thank you, Jawar sir. Thank you so much, Ji, for sharing your valuable time and your knowledge with our members. Being a CA, external or internal auditor, identifying frauds is an important task and much valuable task which has been imposed on us. We can say imposed because currently seeing the scenario, it has been imposed. Fraud prevention and making aware the company and the employees. What are the anti-fraud programs and can be done, which has to be done. There are different types of fraud we have taken us through, from employee, directors, financial, computer, and preventions to be taken for checking all these frauds. Also, you have given us a detailed fraud checklist and the indicators which will help our members to identify, and even if they are doing any fraud detection audit, it would help them. Thank you. I will request everyone to greet him with a loud applause.
Thank you so much. Thank you.
Thank you, sir. Thank you very much.
Yeah. Now we request second speaker, CS Smriti Parikh ji, to take over the charge of the session.
Sure, thank you. I'm audible, right?
Yes.
Yeah.
Okay, I will share my screen. It's visible?
Yes, ma'am.
Yes. Perfect. Perfect.
Okay, great. So thank you, Borivali CP Study Circle, for having me here. The topic I was given today was to cover audit planning and sampling. So it's a bit of theory, and I hope I can keep it interesting by giving you some of my own personal examples. So I will start first with the audit planning. So audit planning is basically, if you look at the standards of internal audit 310, it talks about audit planning and also the international standards of professional practice for internal auditing. That also has some amount on audit planning. So if you look at the SIA, it basically says planning of internal audit assignments for a part of the entity and of course the performance standard. So if you look at the four pillars that are on the slide, this is the basic process. So the first thing, it starts with ensuring that the planned internal audits are in line with the company's objectives, and then that is aligned with the internal audit function and as well as the internal audit charter. So most companies, especially the ones that are listed, would have internal audit charters that define what the internal audit function should do. And it's more of like a policy or a framework within which they need to work, what kind of assignments they will take up. For example, you could take up process audits, you can take up locational audits, you can also take up sometimes theme-based audits, depending on the kind of objectives that are set for the internal audit function by the management or by the audit committee, depending on the organization. The importance of aligning the plan with the objectives of the organization cannot be undermined, because that is what will help the internal audit function to provide value addition. If the internal audit function, works in its own independent way or is not aligned to the expectations of the management or the objectives of the management or the company, then they will not be able to, or management will not find that internal audit is effective. The board may not get what they're looking for, which is an assessment of the real health of controls in the organization. So I cannot stress more on the alignment with the organizational objectives. The third pillar, if you look at, is confirming the broad scope, methodology, and depth of coverage of the internal audit work. So this is also important because it will determine the extent of resources that you will require. It will determine what exactly needs to be covered and in how much detail. Some organizations want their internal auditors to go into detail of areas such as inventory, for example, if they feel inventory is equivalent to cash for them. Whereas some might be having an asset or an inventory light model, and they might want more focus on, or it's a service organization, they want to focus more on other processes such as billing or how well their cash flow management is happening or things like that. So it really depends on what is the scope and the depth of coverage. And of course, that leads to the fourth or the final pillar, which is that we need to ensure that the overall resources are adequate based on the previous three pillars. And also that we have skills that are in line with what we expect to do. And we're focusing on areas which are important to the reporting entity. So either the board or the management, depending on who the function reports to. Just give me a second here. Right. So I'm getting a little bit more into the requirements of the standard. So the planning exercise should follow a process, and this is necessary that, this planning process is documented at least broadly in your charter or a procedure manual or whatever other document you want to call it that would have this process documented, so that should you have people take up this process or new people who are coming in, they are able to perform it. And in the same manner in which it is done, because internal audit for most large organizations is not a short-term process. So you could have plans that go, roll over 3 years, for example. So if you have someone new coming in, you want to make sure that they are able to carry it forward. So the first step is that internal audit plan shall be reviewed and approved by the highest governing authority responsible for internal audit. So like we spoke about, it could be the managing director, it could be the audit committee, preferably the audit committee is the way to go for an independent internal audit, which means it's independent of management and they have access and they are able to talk about the most important risks for the company. But having said that, even if it is approved by the audit committee, it is still important to have discussions with all stakeholders at multiple levels, because that makes the plan better, more, it will have better receptibility, more acceptability, in the results of your audits. So for sure, having a discussion with management and other stakeholders to understand what needs to be audited, what kind of risks they see or perceive. It could be something that they are expecting will devolve in the future. It's also important to have discussions with business stakeholders, because they will tell you, suppose they are planning to launch a new product and it's going to throw up some kind of risk that you can perceive now, you can build it in to your audit plan. Similarly, if they are getting into a different market or a different country, say if you're looking at getting into a country that has sanctions, for example, then those are things that you can point out to the management at that point in time, or undertake specific reviews to address these kind of risks. So it's important to have these broad discussions at every level. The third step that they talk about is to prepare an audit universe. We get into more detail of what kind of or different methods to prepare an audit universe and some examples. This establishes the overall base for the plan, and a risk-based plan exercise shall form the basis of an overall audit plan. Of course, we want to make sure that we're risk-based, and the audit universe and the overall audit plan shall be continuously monitored during the execution phase. So like any other planning exercise, planning is not completed at one point in time, say at the beginning of the year. We need to continually look at it. It needs to be refreshed or changed if there are certain areas that require that kind of change, or if there are circumstances that require that kind of change. So this just gives you a brief of the standard. Next, we go into more detail of how to do each and every step of the planning methodology. So the first thing and the most important step, of course, is obtaining knowledge of the business and the environment of the business. So if you've been an auditor for a while and you've gotten some feedback from your stakeholders, especially management or business heads, one of the biggest complaints that I usually seen is that, oh, the auditors came, but they didn't know what we do. So their observations were not relevant to me or to my function or my department. This is the most common complaint. And that is why before we start even an overall audit plan, the most important thing is to understand the business, to understand different aspects of the business from a strategic perspective, from an operational perspective, from external environment perspective, internal environment perspective. All of these are important to know the organization better. You could be internal auditors to your internal organization, so you're expected to know the organization actually better. Compared to being consultants to an organization, you're still supposed to get this background information from the organization itself to be able to perform better. So regardless of whether you're consulting or you're an internal auditor, this step is a must. I cannot stress more on it, and I'm sure the experienced auditors there will agree with me. The next step is discussion with management and stakeholders. We covered a little bit of this. So again, this is also an important one because it tells you what, suppose, different industry dynamics, a company's business model, intricacies in terms of their operations, any legal or regulatory issues that they have in the past or are going to have in the future. So the general environment as well. What kind of processes they have mature important considerations which could come out from having step 1 and 2. The third one, which is to look at the audit universe and the scope of coverage. So prior to defining the scope of audit, a complete identification of all auditable units. So whether it is locations, functions, business units, legal entities, third parties, etc., of the organization should be made. This list of auditable units is generally referred to as the audit universe. It covers every single conceivable unit for review during the plan period. So your plan period, like I said, could be depending on the size of the organization, 1 year, 2 years, 3 years, 5 years. Ideally, we should go above 5 years. 3 is usually a good number for large organizations. And this helps in basically assuring that you don't miss any auditable unit. Of course, you can combine a couple of units together, etc., when you go further into your planning exercise. But the first place to start is have a comprehensive list. So it ensures that you're providing the assurance on all possible auditable units. The next step is risk assessment. Now, if we are making a risk-based audit plan, and that is usually the way people perform their audit planning, the first, one of the steps is to make a comprehensive risk assessment. So once you've listed out all the auditable units, we need to assess the risks in these identified auditable units. So one more thing in step 3 is once you identify units, you could also identify some which are not auditable. For example, communications function. You may not want to audit that in certain organizations. So you exclude those. A risk assessment will further validate these auditable units and also tell you what is a high risk area, which needs more attention or is more sensitive or is more important for a particular organization, or which ones are low and may be done less frequently. So the purpose of the risk assessment is basically to get that. Risk assessment is known as a doorway to have maximum impact with minimal effort. Because obviously your audit resources are restricted. You're not going to get an unlimited budget or unlimited number of people to perform the audits. So this helps you get maximum from the available resources. The next step is technology and deployment and resource allocation. So a key element of the overall audit planning exercise involves understanding the extent to which an entity has deployed its information technology or IT in its business, in its operations, in the way it processes its transactions. That will also determine how the auditor will deploy IT tools, whether they will do data mining through data analytics procedures, or they have a lot of unstructured data and they need to look at other resources that will be able to pull out such data. So this understanding the technology of the company and then understanding what kind of resources the auditor will require also happens in the planning stage. And this, of course, will have a big impact on the audit plan itself, because if you have to have a lot of manual testing to be done, you need higher number of people to do it. If you have a lot more through the computer or data analytics or audit tools that can be used, then you need lesser number of resources, but require particular skill sets to carry out that audit. So it helps to design and plan the audit more efficiently and more effectively. And of course, like we said, it has a huge impact on the resource allocation. So you will need to understand what kind of knowledge, what kind of experience, what kind of expertise the people require, how much depth that they require to go into. That will also have an impact on what kind of resources you will require. And should you need resources with specific skill sets, then this is the right time to identify that, because you've also identified auditable units at this point in time. And the last step is documentation. It's of course important to have the entire audit planning cycle documented. It's a good idea to have a summary of all your meetings and communication with stakeholders documented. The risk assessment, of course, should form a part of your audit planning documentation. And the competencies, for example, of your resources, your technology roadmap, etc., would all form part of the documentation. Just a quick check. My slides are still moving, right?
Yes.
Okay, great. So next we go into a little more detail on the audit universe. So broadly, we saw that the audit universe comprises of multiple activities, operational units, locations, processes. It could be departments, all of these which are subject to audit during the plan period. So you could have multiple kinds of audit plans. Ideally, for a company that has multiple locations, it's a good idea to have not only processes. You could have a matrix plan where you have processes on one axis and then multiple locations, so that you ensure all processes at every location is covered. So depending on the kind of organization, that's how you would map out your audit universe. Also, the audit universe should have, it should reflect, of course, the overall business objective, changes in management's course of action, corporate objectives, etc., which we discussed. And this audit plan, like we said, is not static. It needs to be refreshed to see if you need changes to even the universe. Should new areas, new businesses, new processes, etc., get added during the year. So a reassessment is necessary. It is a good idea to relook at your universe at least 6 months down the line if your audit schedule is, say, for 1 year. Now we move to the internal audit planning process in a little more detail. So this is just a visual way for everyone to understand how prioritization is done. So prioritize risks from risk assessments. Of course, that gives you your first set of prioritization as to what's important and what's not. The expectations of management get built into this risk prioritization. You could have multiple other assurance functions that are also present in the organization. They could be your SOX auditors, they can be risk management as a separate function, for example, who would be doing their own risk assessments. There could be ISO auditors, there can be tax auditors, there can be so many kind of audits that an organization is subject to. It will be a good idea to get inputs from these during the internal audit planning process, because it helps you prioritize what internal audit should cover. It will also help to deprioritize and avoid duplication where there are other assurance agencies that are providing assurance on the similar things. So for example, in my organization, we have a specific safety audit, which is mandatory for the organization. So then internal audit does not repeat a safety audit. Number one, we don't have the right skill sets to perform a safti audit, and the auditors that do the safety audits have the skill sets, and it's a lot more in depth. So then we park those areas, we document why we don't audit them, and we still take on board the issues from these audits to ensure that our plan is complete. Or if the risks are having an impact on other areas, then we can include those. I just want to talk about one other method that I've seen that people use for planning, which is the VED method, or short for vital, essential, and desirable. This is a method to classify the entire universe into, say, 3 buckets. This is also something when we look at a company's inventory, they will do like an ABC inventory analysis. It is similar to that. But here we are classifying, say, an audit universe of processes into what is really important to do, which has a huge impact in terms of the strategy or the objectives of the organization, or has a big financial impact, has a big reputational impact, or a huge operational impact. Processes, if they didn't work, would shut down the business, for example, or call into question a going concern. So these would fall into the vital bucket. And they can be done in a 3-year plan, say you do once in a year. In a 1-year plan, you could do it every quarter, depending on how the plan has finally turned out. So if you go on further to look at essential processes, these are ones which are essential to the operations, but they will not cause a complete failure or stoppage of the enterprise. So they're still essential, like your HR process. You cannot have an organization without an HR function, cannot have an organization without a finance function. So some of the operational processes, again, say in an inventory management cycle, packaging material is as important as the inventory itself. So these could be examples of essential processes which are audited little less frequent than vital processes, but more frequently than desirable processes. And then the third category, which is desirable, which are a good idea to audit once in a while, but they are not critical. So they could be processes which obviously do not affect your business in a major way. So these are done, say, once in 3 years in a 3-year plan, or maybe just once in a year for a not so important and a 1-year plan. So this is one way of ensuring that with limited resources, you still cover the universe that you have mapped out. So what I've done is I've put different kind of considerations into this slide. This is also built for larger internal audit functions where you have multiple areas and locations to audit. So, and you would also a mature internal audit function where you've looked at everything a couple of times and you need to look at it from a different angle or a new angle. So this is more relevant from that point of view. For smaller audit functions or smaller organizations, probably repeating the same plan on different frequencies might help. So getting into some of these blocks, we've looked at the vital, essential, desirable processes. Another way to structure the universe into auditable units is to focus on certain themes for the year or certain areas for the year. So for example, in my organization currently post-COVID, logistics has become an important process for us to concentrate on. So then that would become a focus area for me in my audit plan for the year. So I would look at logistics from every angle, inward, outward. I would look at factories, I would look at depots, I would look at the distribution channel. So because it's a focus area, I'm looking at the whole gamut of activities, and I will have multiple audits around that focus area or that theme. Instead of having one audit that says logistics, which could be when it is not in focus in that year. So that's an example of how you could decide focus areas or themes. You can also have themes such as looking at one process across multiple locations. Say in a factory-based setting, you're looking at maintenance processes across different factories of the equipment. So quite specific, but it's a theme that helps compare one location to the other or one plant to the other, depending on what you're looking at. Then the other type of audits that can be included are surprise audits. So a stock count could be a surprise at a particular location, which is of higher risk, or where there has been, like my previous speaker spoke about, some risk of fraud in those areas. Those could be checked on a more surprise basis. This may not necessarily form part of the plan that is distributed, but is kept to a few people. You can also have spot audits, which is looking at a particular sub activity in a process in a lot more detail because there has been some anomaly or some red flag that has come to the auditor's knowledge. So, of course, this requires that the auditors have ears on the ground, which is the only way they will know that, okay, here something doesn't look like it's going right. So we want to take a look at it again. And again, connecting with the previous speaker's presentation where he talked about a lot of red flags that you could potentially see. So suppose you saw one of these red flags and you want to look at that process in more detail, that could form part of the spot audit in an audit plan. Then on the right hand side of the screen, you see stakeholder feedback, which of course has great implications on the auditable units, and something called an audit holiday. So what we used to do in one of my previous organizations is we had a list of 72 or 75 auditable areas and a small team. So we had to determine how best to plan the activity to ensure that we are still covering everything, and in a 3-year period, which was a huge challenge with very mature processes. And what we had done is we had prepared a methodology where we took feedback after every audit from stakeholders and from the audit result itself to see how well that audit had done. So we had an objective score given to how well every audit did. And also maturity of the processes in the organization. And we use these scores to see whether, even if a process was very important, but had done very well in terms of scoring, in terms of the maturity of the process, of the controls, having no significant issues, then we would skip that regular cycle for this particular area. And that would be an example of an audit holiday. So these could be the possible exclusions to the plan depending on how well, again, that process is doing. So just some broad considerations that could be built into audit planning. That was the point of this slide. Getting into risk assessment in a little more detail, of course, the auditor must analyze key risks, look at mitigations, look at the overall governance framework. If there is a separate risk management function, look at how that is being done or monitored. It could even form one of the auditable units to be audited to see how much reliance can be placed on that risk assessment. A risk assessment should be both qualitative and quantitative. So it's not just about numbers and being objective all the time. There are certain things which are perceptible to an auditor, which may not necessarily be possible to quantify, especially when you're talking about reputational risks, legal risks. Things like this may be more qualitative than quantitative. Formally documented with written analysis, rationale to support assumptions. So every risk assessment is based on some set of assumptions. For example, that this type of business is going to go on for these many number of years, or this kind of product as at the end of its life cycle, etc., etc. So there could be multiple assumptions that go into business planning, similarly to a risk assessment. It should be ideally, like we said, approved by the audit committee at least annually or when it materially changes. Below are some blocks which are factors that can affect risk assessments. It could be factors internal to the organization, external strategies, issues faced in the past. If there are a lot of statutory non-compliances in the past, probably that's an area that will require more focus or is a higher risk. If the company is operating in a market that has severe competition, or it is a marginal player, or their price is dependent on competitor pricing and therefore changes or needs to match with a competitor. These are the kind of changing market conditions that can be looked at. Of course, changes in laws and regulations, systems, business model. One other thing that I would like to spend a little bit more time on is the risk appetite or the tolerance levels. So this is dependent on the management. So you can talk about this in a way that says that, okay, the management or the audit committee is okay to accept level at this risk, at this level of risk, and the above that they want everything to be assured. So this determines again the extent of audits and the extent of depth of audit also that you want to cover. So these are the kind of considerations that go into risk assessments. The internal audit planning process, in brief, I'm not going to spend too much time on this. So you will have planning with for consultancies, engagement letters, initial meetings, preliminary surveys, internal control reviews. You will start with audit programs, field work, of course, get into reporting, and then follow up. So that covered most of what I wanted to say in terms of the audit planning process. I would just like to give you one example of a particular planning exercise. So if you have, say, for example, an institution, if it's, say, an educational institution, for example, you would have, say, a faculty section, you will have an enrollment section, you will have a library, you will have academies, reputations, you will have HR, IT, safety, security, all of these kind of functions. You could have a multiple campus-based university. So in this example, just what I wanted to explain was, in an audit universe, you will have, say, academic administrative units, centers, which form your one axis, and you will have your core processes like risk management, strategy, financial planning, IT, HR, etc., which form your support processes. So this is how you would make an audit plan. In terms of risk assessments for audit planning, it is easy to do risk assessments with a heat map. It helps to place auditable units in the heat map, saying, okay, on your right hand side you'll have the most important or the red category risks, and the lowest ones on the bottom left. So you can play around with risk maps to give not only the audit function but also a board or an audit committee an idea of what the risk assessment was finally looking like, and then a final listing of your audit plan. So that's it in terms of audit planning. I'll move to audit sampling. I will go over this a little bit quicker, because sampling is something that most auditors do, but with the advent of technology, there are other methods to do sampling. So I will go over some of this a little faster. So audit sampling. What is audit sampling? It is basically when you can't look at 100% of the population, you look at a subset of the population. Just a word on audit population. It is the entire list of transactions that you have, a comprehensive list of transactions to look at in a particular auditable unit. So if with limited resources and if you have to do manual auditing, it is impossible to look at every single transaction. You could have thousands of bills, say, or 10,000 purchase orders for large organizations, or inventory worth crores, which could be your population, and you cannot really test each and every item. So that's where sampling comes in. So sampling is based on the objective of the audit. So it depends on what kind of assurance is required from that particular audit project. Sufficient understanding of the internal control structure is required to plan the audit and to determine the nature, extent, and timing of tests to be performed. This is a basic that every auditor understands. There is an SIA again on sampling. It deals with the design selection of an audit sample. It provides guidance on the use of audit sampling in internal audit engagements. So it's a good idea to go through it. There is also mention of sampling in the in the IPPF by the IIA. And generally the two kinds of sampling methodologies are statistical and non-statistical methods. So looking at the selection of an audit sample, like we mentioned, consider the objective of the audit. So is what we talked about even in the planning exercise. When you're doing an overall planning, one of the things we mentioned is, okay, how much depth do you want? What is the level of assurance that is required? Are we just looking to see that, okay, overall things are fine, or do we want to look at a specific area because we have a red flag and we know that something is wrong in this area? So depending on what objective you're going into the audit, that will determine the extent of sampling and the nature of sampling. It will also have an impact on the sample if you know the characteristics of your population. Are there frequently occurring similar transactions, infrequent non-similar transactions, transactions that are concentrated in certain seasons, for example? So it could be the population can be different, and based on that, you can stratify your samples or select the most appropriate ones to get the result that is required. So auditors should select samples in such a way that the sample can be expected to be representative of the population. This is especially important if you're going to use the sample to extrapolate to the entire population. And when you do not have a chance to go back and select additional samples and retest. So then it's important to have representation in the total population. So looking at the key points of audit sampling, what determines the sample size? So 3 things that the auditor should consider. The first thing is the sampling risk. This is something that every auditor has to know, that there is always a possibility when you're doing sampling that the conclusion is based on a sample is different if the entire population was tested, of course. So this is an inherent risk that is there in every single audit. So therefore, representativeness or the way or the method in which the sample is selected becomes really important to ensure that you minimize the sampling risk. The second one is the tolerable error. That is the maximum error in the entire population that the auditor is willing to accept. And that determines the extent of your testing. And the third one is the expected error. This is determining, determining expected error considers matters such as size and frequency of errors identified in a previous audit, meaning how healthy were the controls last time it was audited? Or again, were there any red flags identified through other assurance agencies which have done audits previously? Either one of these could be inputs. Changes in the entity's procedures and evidence available from other procedures. So all of these can go into what is expected to be the error rate in a population. The lower the risk the auditor is willing to accept, goes without saying, sample size needs to be that much higher. And that means that it will require that much more resources for the auditor to complete the exercise. So other factors that affect sample size, the first one being, of course, the population size itself. If it's an activity that occurs 4 times a year, you could audit 100% and not have to do any sampling. Or you have transactions that occur multiple times a year, they're quite structured, then you need to pick samples from particular strata or stratified sampling. Of course, the second one is the amount of confidence that the auditor requires. So goes to say a higher degree of confidence the auditor requires, the results of the samples are indicative of the actual incidence of errors in the population, the larger the sample size needs to be. So higher the confidence, larger the size. That's how the correlation is. The third consideration is risk. of course, in the areas where we've already assessed the risk to be high. So there is risk at the overall planning level. And then when you go to an audit assignment, every single assignment should also have, ideally, have a risk assessment to know within that area what is the kind of risk to expect in different sub-activities or also overall basis. So in high risk areas, a large sample will be desired because high confidence levels are required and narrow precision intervals are required. Meaning you want to test more at, say, just not one sample every month for a multiple transaction one, but say one sample a week. That is the difference in terms of precision intervals. And then, of course, the rate of deviation. The higher the rate of deviation that an auditor expects, meaning the larger number of errors or the larger possibility of controls failing, the larger the sample size needs to be to make a reasonable estimate of the actual rate of deviation. The lower the rate of deviation the internal auditor is willing to accept, the larger the sample size needs to be. Now, moving on to the different kinds of sampling. So like we said earlier, there are two main types. One is statistical and the other one is non-statistical. I won't go into every single type of sampling, but we'll look at some of the main ones. So this is statistical sampling. So it's statistical sampling is an approach where the auditor uses statistical methods like random sampling to select the items that need to be tested. So random sampling is used when there are many items or transactions on a record. So your population is large. So there's an example given here. Consider a company with more than 100 inventory transactions on its records. Using statistical sampling is recommended due to the high level of transactions. For example, if 10 items are selected from the total population randomly, every single item within the 100 has an equal probability of being selected and tested to know the accuracy of that result. So it benefits auditors since they can still have an audit opinion, but don't have to look at obviously the entire 100. In statistical sampling, there are two techniques. One is random selection and the second is systematic selection. So every particular number or a random number. And the second type of sampling is non-statistical. So here the items are not chosen completely randomly. They are chosen based on the the auditor's previous knowledge or the auditor's judgment. Like I said, if the auditor has ears on the ground, they will be hearing a lot of things about the organization and they use that judgment to select the best sample. One thing that I've usually found is when we have opening meetings for internal audits, that's the best place where auditors are able to judge where they need to take the audit or that particular audit area. It gives a lot of insight into how the auditee is reacting to particular statements from the auditor. It gives a lot of insight into the potential issues that you could focus on. So those meetings are really important to build auditors' judgments. And then that helps you in the sample selection. The result of testing from the selections is not used to infer conclusion for the entire population. So obviously, since this is not statistical, it may not necessarily be representative of the entire population because we have made a biased call, a particular bias towards a particular item that needs to be tested. So this is something that one needs to be careful about. Also, judgmental sampling is the most popular method used by auditors generally. Not many auditors use statistical methods unless you have a particular objective that you're trying to reach, or the kind of transactions are like that, of course. So if you look at the earlier example and now apply it to a non-statistical audit sampling, 10 inventory transactions can be used to infer an opinion on all 100 in the earlier example because it was statistical. Now in non-statistical, you cannot do that. So here the auditor is looking for something different. Therefore, they don't need that methodology. They could be looking at items of higher value. For example, here it's saying above 1 lakh. or for a specific information, like it's concentrating on a particular type of companies that they're interacting with. Or suppose there's been some information that a particular vendor has some allegation of favoritism, you want to concentrate on inventory from that vendor. So these could be the reasons why you go into non-statistical sampling. The non-statistical sampling, the possibilities are haphazard selection, block selections, particular time periods, seasonal businesses, completely judgment based on what we talked about earlier, or risk-based sampling combining elements of all the other types of non-statistical sampling. Then looking at just simple random sampling. Simple random sampling takes a small random portion of the entire population to represent the entire data set. And each member again has an equal probability of being chosen. So it could be that, you know, the 25 employees, the names of 25 employees are being chosen out of a lottery system or a hat. So each employee has an equal chance of being selected. So this is especially when you want to have certain control tests that need to be done. This is a good method to use. I think the rest is self-explanatory. And looking at systematic sampling, this is where you choose a particular item at a fixed interval, for example. So each 20th item after a random starting point. This can be an example of a systematic sampling. So when you use systematic sampling in this manner, you must carefully understand the behavior of your population. Because if we're saying that there is a purchasing that is done by a separate team who is focused on purchasing other than people who are involved in operations for above 3 lakhs, then you cannot use this kind of systematic sampling because you could possibly miss that kind of transaction. So you have to be careful when selecting the kind of sampling methodology. So here, like it's saying, you might have different types of customers in the store at separate times. Store may have more retirees during daytime hours, on weekends, teenagers after school, working people in the evening. So if you have this kind of population, you don't want to go by a particular exact interval. Then stratified sampling, another important one, which is why I have a slide on this. When you're looking at dividing the entire population, especially if your population is quite large, or your population has characteristics which are concentrated in certain areas of the population. So the entire population is divided into homogeneous groups. Important one, homogeneous groups, which is called strata. And then within the strata, you use a different method or a similar method to again pick samples from the strata. So there's an example given here, which is analysis of manual purchase orders would require classification of population based on document type to form strata, from which samples are drawn and analyzed. So this kind of sampling also ensures that your sample size reduces because you're not looking at 100 transactions and then sampling on that, but you're dividing 100 into 25, 25, 25 of these 4 different types. And from that type, you're again picking samples from each type to ensure it not only covers every type in your population, but it ensures that you could possibly do judgmental sampling on one type and do statistical sampling on another type, depending on the population. So sampling, of course, has advantages and disadvantages. You are able to sketch conclusions about a population without testing all samples. That's obviously an advantage. And there's always a risk that the sample is not representative, which means that the auditor may not reach the right conclusion based on the sample. And the auditor has to determine and accept this risk or carry out procedures that compensate for this kind of risk. But since this is an inherent risk, it always remains. To focus on high risk or high value items to distinguish between elements of a population, which may be subject to differing internal controls. And a disadvantage is sampling relies on use of judgment in relation to exceptions, materiality, and in drawing conclusions. Now, we cannot, in this day and age, post-COVID, not talk about sampling without talking about data analytics. So data analytics is the possibility where you may not need sampling at all if you're able to look at every single transaction that you have. But of course, to apply data analytics, the organization needs to be having data in a analytical format, or you need to have a tool that is capable to look at data which is say from scans or PDFs or from other say non-Excel or non-ERP driven data. So of course your data analytics will be only so mature depending on the kind of transactions that you have and the manner in which it is recorded. So data analytics helps to look at root causes during investigations. It can give you real-time reports if you set up certain data analysis to do so. It helps in risk quantification. So this is the reporting section where data analytics can help. Also in the planning section, it can help by doing risk profiling, data simulations, and statistical sampling, of course, because that is the structured method of sampling. And it also helps in audit execution through control simulations, predictive risk identifications, fraud indicators. The previous speaker spoke a lot on these kind of fraud indicators. A lot of these are amenable to data analytics, and of course for control monitoring as well. So you can do continuous auditing where you set up certain controls in such a way through data analytics that they continue to run at a particular frequency. They generate reports which either the business themselves looks at or the auditor looks at these exceptions and then determine whether they need to be looked at in more detail or the controls are working fine and healthy. So this could also lead to continuous monitoring. So I'm not going to get into the details of where data analytics can be used, but in general, it can be used in a purchase to pay process. Huge benefits there. Accounts payable, receivable. A lot of fraud analytics are done through data analysis, so duplicate detection, especially when you have large data sets. It's much easier to import large data sets into tools like IDEA or ACL and then look at exception reports. It reduces the time spent and it gives you huge amount of coverage. You can do continuous auditing that we talked about for sampling, fraud detection, payroll timesheets of employees. If you have a service-driven organization where people travel a lot or you have lakhs of employees, then these methods are not only important, but an absolute basic necessity. You can also use it for inventory audits, etc. So continuous audit, I thought I should put a slide in because this is not the future anymore, but some organizations have already adopted this. So it's one step forward from a data analysis. It's a real-time capability for financial information to be checked and shared. It doesn't need to be only on financial information. It can be done for any information that is possible to quantify in that manner. It indicates integrity of information to be evaluated at any given point in time. So it can be run as often as required. Information can be verified constantly for errors, for fraud, for inefficiency. It tells you the effectiveness of your controls every point of time. Automatic methods are used to perform auditing activities, controls, and risk assessments on a more frequent basis. This also means that the audit function or the auditors need that kind of skill set to be able to do this kind of implementation. Technology, of course, it plays a key role. It helps to automate identification of exceptions and anomalies, analyzes patterns within digits of key numeric fields, reviews trends, tests controls, and can lead to a much more detailed audit or a much more high-level audit depending on how they're designed. I will not go into this. Just some advantages and disadvantages of continuous auditing. It gives you a detailed analysis of data. It has minimal audit risk. So the inherent risk is reduced to a great extent. No sampling risk. detection of error and fraud in an early stage. So most auditors, while audit is not, the basic purpose of an audit is not to find fraud or errors, this increases the chances of audit finding frauds or errors. The challenges, of course, are accessing complex, diverse systems and tools. So the more complex the ERP, the more complex it will be to set up such a system. Reluctance to expand the use of technology. You will find in a new implementation, there's a lot of pushback, not only from management, but also from the auditors themselves, because you need to upskill. They need to learn how to use these tools. Sometimes false positives in data analytics and continuous auditing can be very high if the data set or the tests are not properly configured. And of course, that means it requires a significant amount and continuous training. And every time something changes in your ERP, you need to relook at what you set up as the tests. So it requires continuous monitoring. There are advantages, of course. The set of technologies to reduce business losses through continuous monitoring, so you can greatly reduce losses, reduces the cost of auditing, and this is demonstrable for sure. I've done the working and I've seen the advantage. 100% real-time monitoring, deviations, exceptions are highlighted on a continuous basis, and incorrect entries basically are not allowed to be processed. You can set it up in such a way that it not only gives alarms, but also restricts certain transactions from going through itself. So some of the examples of segregation of duties, etc., you could stop certain transactions from happening at all, depending on how mature your control monitoring is. So that's the end of my presentation. Just to conclude, audit planning is a critical part of an internal audit function and the way that audit works, and performing the correct audit plan could be the factors that lead to the success of an audit engagement and that audit firm, if that is applicable. The use of sampling is widely adopted in auditing because it offers opportunity for an auditor to obtain minimal amount of audit evidence, which is both sufficient and appropriate, and to form valid conclusions from an entire list of transactions. Audit sampling is also widely known to reduce risk of over auditing, especially organizations that are subject to a lot of different kinds of audits from different regulators, highly regulated industries. This is a kind of problem that you can have, and enables a more efficient review of working papers, review of stage of audit, etc. So that's it from me. Thank you very much.
Thank you very much, ma'am. Yeah, Dipen.
Sir. Thank you, ma'am. Ma'am, we have one question from a member. For data analysis and degrees, any degree is required? Which college or institute is based in Mumbai? Particular or any good software to learn or operate?
So there is no requirement to have a degree. Data analytics can be studied as a topic now. I think colleges have that now. Unfortunately, I am not very sure which is the right place to go. But in terms of software or tools, there are multiple tools available. The ones that I have used in the past is IDEA. I've seen the use of ACL. IDEA I've seen is easy to use. It's quite user friendly. There are multiple other tools that are available. It also depends again, like on how well trained the auditors are. So I really can't suggest one over the other because it would depend on what kind of function you set up or what is the organization you're trying to audit. So.
Okay, thanks.
Thank you. Thank you, Smriti madam, for enlightening all the members on how to plan the audit in internal audit area and what the sampling needs to be used. And what is the VED, vital, essential, and desirable categories to be used for plan the inter audits. Then you also enlighten us about what is the advantage and disadvantage of sampling and the continuous audits. Thank you very much. Now I request Dipen to propose the article of text to the speaker.
Thank you, Jawar sir. Thank you, ma'am, for sparing your valuable time and sharing your knowledge with the members. Audit planning is an essential or heart of any planning. So when you start an audit planning is must, and it has to be done at the start of audit. Audit planning also has to be done on continuous basis, depending on the phase of the you can say audit. Also, we thank you for taking us to planning and sampling in detail, and you have taken us with along with that examples and your practical experience. Thank you, ma'am. I request everyone to greet her with a loud applause. Thank you.
Thank you.
Thank you, ma'am.
Thank you, ma'am. Yeah.